So we're going to talk about trading this 5-minute time frame with precision. I'm going to go through a little introduction, everyone, and lay a foundation as to why we're going to trade it, how we're going to trade it. And at the end, I'm happy to take your questions. If you have questions while I'm presenting here, you're welcome to put them out there. And of course, this is, to learn and guys, help you all make money in the markets, of course. A little bit about myself. Like maybe some of you, I started out back in the late 1980s knowing absolutely nothing. And I say, how do you trade stocks? I honestly didn't really know the difference between a stock and a bond, and started that search for the holy grail, if you will, and educating myself through the little bit of information that was out there at the time. And after doing that for some time, eventually, and it really in a effort just to produce some income to supplement my costs for trading at the time, which were a lot more money than what they are today. Just hearing Joe's offer and the option for trading commissions is just unbelievable. I mean, data feeds back then were pretty expensive. There was no internet. Eventually formed a company called Pristine back in the end of 1994, which eventually took off on its own with the growth of the internet, and became quite well known at the time. During that time, I did many trading challenges at expos, wrote a few books, educated a lot of people even in the industry today that teach, as well as professionals, whether they're hedge fund managers and market makers and such. There's a lot of my students today actually teach at other companies by what they've learned. And today, I just actually creating a new course called Master Trader Technical Strategies. And so as I continue to educate today, these are some of the books that I've written. You can find them on Amazon. I'm sure they'll help you in your trading as well. There's a little step back in time. This was me with thinner and a lot more hair, a little over 20 or almost 20 years ago anyway, at the first Traders Expo. You can see the booth there behind me, and what we were advertising at the time, the training and education and technology and such. It was a long time ago. It was a lot of fun back then. Still, I've gone to some money shows as of late, but not the expos themselves. Visit my site, mastertrader.com. You can sign up for a free chart of the week. These are some of the lessons that you'll find there, and you can read or videos. And we send these out on a weekly basis. A lot of education there that you could always pick up a few things. Can you also become a pro trader? It's possible for anyone, of course. Getting educated, getting experience, and so on, just like any other profession. All right, so this animated picture of the fellow holding his head with all the question marks. When I started educating myself and using the first trading platforms with all of the indicators, not as many back then as there is today, but I went through a period of mass confusion trying to figure it all out. And over time, I actually got to the point where I had to say to myself, Greg, you're either going to have to give this up as a thought of doing this for a living and making money at it, go back to what you were doing, or figure it out. And the way I did that was to remove everything from the chart, all the oscillators and all the indicators and such, and clarity came. And I thought to myself at the time, well, why are all of these things being used? Because they just raise so many more questions than providing answers. And found out that it was the foundational basic stuff that I began to read about that actually worked. Just simple things like support, resistance based on price, and the trend, and the saying, the trend is your friend, is one of the most powerful things that I think a lot of us take for granted in its simplicity, and looking for the sure thing that many of us, I know I did, kind of ignoring those things, and in the belief that the market has to be complicated and to be successful at it, and nothing's further from the truth. The simpler you can make it, the greater your odds of success. And some of the things that I'm going to show you today are simple but powerful, and your biggest hurdle is probably going to be just following the simplicity of it. And if you do, I think you'll make money doing it, if you can follow the rules. So the foundational components: price is king, everything else is secondary. And it might be your internet connection, John. I don't know if anyone else, he says the audio is clipping in and out. It's usually due to internet, but if anyone else is having a problem, let me know. Candlestick analysis. Others are saying that it's good, John. So, yeah. All right. So, candlestick analysis. Why candles? Just visually makes things jump out. You can look at a bar chart and come to the same conclusions. There's nothing magical about indicators. I mean, the candlesticks, it's just that you can just see the pictures that communicate to you a lot easier. Someone's saying they swear by the cloud. Well, to each his own, Bo. For me, it's just a picture with a lot of noise on it that hides what matters, and that's price. But if it works for you, fantastic. Trend analysis is following the trend in multiple time frames is what will put the odds in your favor. Many that are intraday traders, especially, focus on time frames that are too small. And while the belief is that you're going to get a tighter stop, more times than not, it works against you, and you die that death of 1,000 paper cuts, just getting hit with too many stops. So by employing multiple time frames and then moving down, and we're going to move down to the 5-minute time frame, the odds will be in your favor. Support, resistance, volume. Volume, I say, is secondary. Many will, use volume, I think, in an overemphasizing it. In reality, we could trade without volume, but I find it to be excellent at alerting me to probable turning points, volume spikes after a move. The volume spikes that happen that ignite a move, you're usually going to be part of that. So it's after the fact, but as prices are moving in a direction and the volume spikes, you pay attention to that, and usually it's going to happen before a turn comes. Position and money management. I mean, that is so key to being successful, because even the best chart reader won't necessarily be profitable without a way of managing the position and of course the money. And that's the focus of Master Trader Technical Strategies. Now, what I'm going to show you today can be applied to any tradable instrument. Options have their own level of education that's needed to do them. But one of the things that we do at Master Trader is not only use what's called the Greeks, the numbers of options, but we combine that with the charts. And many option traders don't. They just look at the numbers. And if you add the technicals with that, if you're an options trader, it just adds a level of success to that. I'm just reading some questions here. Will it work in India? If you can chart what's happening in your market, it'll work. And technical analysis is the same regardless of the instrument or where it's being traded, because we're all human, and we're all reacting to what's happening, whether in the news, and we're risking our money to do that. So the patterns occur regardless of what you're trading or where you're trading it. Let's simplify what we're doing here. So when it comes to candlesticks, there's no need to start memorizing names or thinking that, you know, this pattern is has greater odds than another from the point of view of what the name is. Many of the patterns that change, whether it's a bottoming tail bar, let me just get my pointer out here, whether it's a bottoming tail bar or a topping tail bar, what it looks like is more a matter of the time frame that you're looking at. Meaning, if you expand the data or compress the data, you know, two bars can look like one bar just by compressing the data. So you need to understand it's really about retracements rather than looking for different candle names. So let's, you know, stopping, if you were looking at have to get over as new traders, as you learn about patterns, price pattern, and thinking has to form for me to take advantage of it. And then you start to look at possibly the time frame. You change similar patterns and how far they retrace. So one of the patterns is the retracement pattern. Prices are in an uptrend or a downtrend, and prices retrace to an area of support and then begin to turn. So the first one on the upper left is just a pullback where prices begin to reverse back up, and that gives us a signal to enter at that point when aligned into that area of support, and then they pull back down again toward, in this case, the upper one toward that bottoming tail bar, and then begin to reverse and then position. And for shorts, we look just for the opposite. Prices retrace back up, and then they retest that prior swing high and then turn back down. We enter a short position. Flags. Prices have moved up, and they usually a flag will have a little bit of a downward slope here. And as I created this with a couple of bars here after the high. It could be 3 bars, it could be 4, be 5 bars. It can happen in so many different ways. So, don't get so what's happening and recognize that prices, whether they were in an uptrend, this may have been an initial explosive move out of a base, and then rather than pulling back to any support, and that what I just explained, there probably is no support unless it goes all the way back down to the base. You don't want that. So it has to create a little support area. And that's what a flag is about. It's creating a little support where the demand continues to come. And then, you're looking for it to, then continue to move higher. And lastly is the base. We want a well-developed base. And most of you, probably a lot of you, are looking for that because trading breakouts and breakdowns is a very popular strategy. With the trend, if prices are moving up, they go sideways. That's another way of creating a support area, and then you buy the breakout above the base, looking for it to go higher. Pretty simple. Now, here was a real epiphany for me many, many years ago, because as I looked through many of my trades, and I would look for, once I discovered or recognized, I should say, really recognized specific patterns that happened, and then I would look at my trades and say, well, everything looks the same to me. Why is this one not going up or down as the same pattern did? Similar setups not moving in the same way. And then I said, well, everything is moving based on supply and demand and support and resistance. Well, what if there was no support or resistance to the left? And what does that look like? So we have a momentum move to the downside. And you have a little bit of resistance here, but as prices move rapidly in one direction, it creates what I call a void. And that could be created by a gap as well. That's why a lot of gap strategies revolve around creating that void, the gap. And then time. As prices move over time, it increases the size of that void. So rapid price movement and then movement over time, you have this void where prices could move rapidly back in the other direction. In addition, over time, what's over here to the left, it becomes less significant as a reference point. And if you think about that, it's really common sense. And you could relate that to, recent history in the markets, where the markets had this bear market that topped out in March of 2000 and then moved lower over the next 2+ years. And the NASDAQ went down, I think it was about 95%. Now, I kind of questioned whether I'd see it move back to the old highs in my lifetime after that drop. Happy it did. But it came a point in time as it started to retrace back up again, where those old areas that were 5 years away, 6 years away, 7 years away, how significant were they as reference points of any resistance? And common sense says really not much. Technically, we look at that because we're technical traders, but how significant can it be? Now, as we relate that to a 5-minute chart or a 15-minute chart, it's relative. But here on this 15-minute chart, as prices move down rapidly and then sideways, we look at it in the same way. And this bullish price action that I've marked here is the fact that prices are chopping sideways in this area of resistance. Now, anytime you see prices come up to an area of resistance and they don't pull back, it tells you that buyers are continuing to show up, and that's bullish. And then we look at the individual candles like I showed you, and I say, well, here's a red one followed by a green one right back up again. Tells me buyers step right back up. And then here's a bottoming tail candle where prices had gone down and then pushed right back up again. And so it's communicating to me that there's strong demand and buyers are stepping up. And I'm going to want to buy that based on this analysis. This bottoming pattern, the move back up, the bullish price action, bottoming tail bar, buy it, and manage from there. Someone's asking, can you email us when it's available for viewing? I'm sure Lightspeed will. As it takes me a minute to switch back and forth so I can move these slides from the pointer. All right. So a little word on moving averages. They're not support and resistance. What time frame are you using for the candles? Well, John, what I'm going to show you is going to be based on a 5-minute time frame, but that's your choice. And as I tried to explain, as you change time frames, the candles are going to look different. So a 3-bar reversal on a smaller time frame, as you look at a higher time frame, it could look like 1 bar. The thing you want to understand is that it's really about retracements, not about the names of the candles. So as I showed you, a bottoming tail, prices went down and they came back up again. So there were buyers lurking underneath. So moving averages are not support and resistance. They can become a self-fulfilling prophecy. So like on the daily chart, what's widely used, the 20, the 50 to 200, these are widely used moving averages on the daily chart, especially by institutions. They see a pullback in a strong stock in an uptrend, pulling back to a 50-period moving average. Most of the time, they're going to be buyers there because that's what they've been trained to do. They use the 200 in the same way. So I don't want to use something different. When it comes to something subjective, like a moving average as a reference point, I want to look at what everybody else is looking at. And you don't see the questions, William, unless someone actually answers them in text and then posts it. It's just the way this software is, and that's why I'm reading them, so you might be aware, others would be aware of the questions that are coming in. Now, I say stop drawing lines on your chart. Right? Stop drawing lines up and down. Yes, John, a simple moving average. If you like exponential, go ahead and use it. The thing is to be consistent in what you're looking at. Right? So a little side on that. I use simple moving averages. If you are trading Forex, maybe they would, those traders would use exponentials just because they think, that's going to give them an edge. In essence, whatever the majority are looking at, look at that. Alma's asking me about a 13-period moving average, which would relate to Fibonacci. If that's what you want to use, Alma, fine. There's nothing magical about any moving average. Right? My point of view is use what the majority are using. You're not going to get an edge by using a 13-period moving average over a 20-period moving average. Be consistent in whatever it is that you're doing. There's no statistical proof of the second. Just look at the chart. If you want to do statistics on it and do a study, go right ahead. My experience over about 30 years tells me that 50-period moving average and that 200 is being widely followed. Can we trade only with a candle? Absolutely. You can trade without volume. You can take the moving averages off, and then what I'm going to show you, I'll show you a way of using moving averages, but once you recognize how prices are moving, you're welcome to take them off. I don't know who Barry Einstein is, but if he's talking about voids and looking to the left, William, he's probably one of my students from the past. A second, I'm just clearing off some of these questions so I can follow them. In a second here. All right. As I said, moving averages are a visual aid, and the 20 is a relatively or comparatively short moving average, so it'll follow the trend. Trends are defined by swing highs and lows. And an uptrend is defined by higher highs and higher lows, downtrend, vice versa. And we want to keep things simple. All right, so a little bit more about moving averages and why I would choose certain moving averages on the daily and or the 5-minute time frame as we're going to use them. So I can use them to see the trend, right, and the location of one moving average from another time frame. In other words, by looking at one time frame, by choosing certain moving averages, I can know the location of that moving average in a different time frame, as well as the trend in that other time frame. My goal here is to trade when multiple time frames are in alignment moving in one direction. Someone's asking me, do I use a 9 and a 20 EMA to determine the entry of a bull flag? I do not. I determine the entry of a bull flag based on price. Now, what I'm going to show you with the moving averages, Michael, if those two moving averages help you see things more clearly, go ahead and use it. As I said before, just be consistent in what you're looking at. There's no magic here, right? It's about having a method that you understand and then just doing the same thing over and over and over again. So what I want to do here is calculate these moving averages to determine what's happening in other time frames. And it's easy to do. Right? So here's examples. A weekly 10-period moving average is the same as a 50-period moving average. I look at how many bars make up that smaller time frame in the larger. In this case, it's 5 bars. One weekly bar, 5 bars on the daily, multiply that by the 10 MA, it gives me a 50-period moving average. So when I look at my daily time frame with that 50 MA, I know the direction and the location of that 10-period moving average on the weekly. My point here is if the 20 is pointing up on the daily and the 50 is pointing up on the daily, that means the daily and the weekly time frames are in alignment with each other, which in part puts the odds in my favor. I'm saying, isn't the magic in seeing what other traders are seeing? If so, what MAs most other traders base their decision on? In part, that's what I said, Joe. I said on the daily time frame, my observation is that the 20, 50, and the 200 are widely used, especially by institutions. Right. So the 60-minute chart, the 20 MA, is the same as a 240-period moving average on the 5-minute chart. 12 bars times 20, 240. I'm just going to use a 200-period moving average. Right? And this is as I'm relating this to the 5-minute time frame. 15-minute, 20 MA, same as the 60 on the 5-minute chart. 3 bars times 20, 60-period moving average. So on my 5-minute chart, I'm going to use these 3 moving averages. Simple moving averages, Jason. A 20, a 60, which is the same as the 20 on the 15, and a 200, which is close enough to the 20 MA on the 60-minute chart. I said from the 5-minute chart, I know all of the trends by looking at the one time frame, what's happening in those 3 time frames. You're welcome. So I'm waiting for this picture. I'm looking for this picture where, one second here. I'm looking for this picture where I have this alignment, especially between the 5 and the 15-minute. I want to see, in case of I'm looking for shorts, I'm looking for this 20 MA to be trending down. And this is the 20 MA on the 15. I want to see it flat to trending down. Hello, Lucas, hello. And I want to see that the blue line here, the 20 on the 5, is under the 20 MA on the 15. Right? I'm saying it's a 20 on the 15, but as I explained to you, it's a 60 period moving average on the 5-minute time frame. And this is what's happening on the 60-minute time frame, right? The 200 MA on the 5. So here they're all lined up. And here I see that the trends are beginning to track in the same direction. Now remember the concept of the void. I also want to make sure that there is a void underneath here, because that is what puts the odds in my favor that prices are going to be able to move either rapidly in the direction of the trend or continue to trend in that direction. This is, I'm not interested in the cross here. Right? I'm just interested in the fact that these are moving together. So as they move closer together in agreement, it tells me that volatility is contracting and it should expand in the direction of the trend and that void. There's no holy grail. I'm not telling you this is any magic here, but I'm telling you that it works because it's based on simple foundational information. Trading in the direction of the trend would avoid a support or resistance or a lack thereof. The odds are in your favor. Pick your point based on the patterns that I showed you and manage it accordingly. This is not what we're looking for. Multiple time agreement is the prerequisite for the trade. Exactly. Right? So as I've explained, the moving averages are a visual aid. I'm trying to keep things as simple as possible, meaning I don't want to look at too much information because I have to process that. So I don't want to look at a whole bunch of different time frames. Once I've looked at my daily chart, my higher time frame, and I've determined that the odds of prices are moving in one direction or the other, I can then move down to my 5-minute chart, and based on what I'm showing you, I know what's happening in the higher time frames by just looking at the 5. Does that make sense? And most of you probably are looking for ways to have multiple time frames in alignment with you and trading trends. You can trade counter trend at times, but this is not the focus of this webinar. That's another strategy. So this is not what we're looking for, where prices are whipping back and forth. And what you see here visually with the moving averages is that prices are slicing back and forth through them. The message here is move on to something else or wait. So if you're only trading one particular instrument, or as they're saying, one time frame, you have to wait for your time frame to set up in a way that's in agreement with your trading plan. Right, Bree, that's what I'm saying. You need one chart. You're going to start with your daily chart to have a bias. Then you're going to wait for this one chart with these 3 moving averages to be in alignment. And that's when you'll place a trade, when your plan comes into alignment. Right, Joe, this is chop. Exactly. You stay away from it. This will generate a lot of commissions and heartache. Does the use of an EMA rather than SMA average screw up the math for the strategy? I would say no. I think you could use either one, Terry. It's a choice. Leon's asked me, is the 5-minute, what do you use for a target entry of a trade? Well, that's based on support and resistance, nothing to do with the moving averages. That's why I explained to you about a void. If your target's going to be quite far away, right? What are the moving averages on the 5-minute to use? The 20, the 60, and the 200, and I explained why. All right, so let's continue here. I know you guys have questions, and I appreciate the questions because it makes doing one of these webinars a lot more pleasurable and fun. can you quickly summarize your entry again? I haven't even shown you an entry yet. I'm just explaining to you what we're looking for as far as I showed you some price patterns and, how to determine the direction of your bias and what to look for. What is more important than entry or exits? Well, nothing, because without the entries and exits, you can't place the trade, but we'll get to that. Okay. All right, so here, as I said, we're starting with the daily time frame. That tells me from this time frame the direction that prices should move in. So I'm showing you a daily chart, which would be a counter trend setup, but that's okay. Right? You could even swing trade this if as a climactic type of a buy setup. However, that's not the focus here. My focus here is to say that this came down to an area of support. There's a bottoming tail bar here, which was a red wider range bar, and it popped back up again. That directs me to the probability that prices are going to move back up into this void, maybe test the 50 MA. But as an intraday trader, my focus is that this is just going to move up here, and I'm just waiting for that 5-minute time frame to come into alignment. And I've explained the different moving averages, why the 200 and not the 240. It's close enough. So I'm looking at the distance, slope, position, and alignment of these moving averages. So there's our 5-minute chart with the 3 moving averages. And here, I see where the 20 is pointing up, the 60 is pointing up, it's just starting to point up here, and the 200, which tells me the direction of the 60-minute chart. So I have alignment here, so I can have a long bias. My bias is long based on the daily, and now the 5-minute time frame is telling me that prices should go up. And I've already determined, I'm not showing it here, but I've already determined that there's a tradable void up above. Here is your the 15-minute chart, and you can see by the little purple arrow, 323.81, and you can kind of underneath here, the green, 323, whatever the number is there. So what I'm showing you is that 60-period moving average is very close, sometimes exactly the same in slope and position as the 20 MA on the 15. And there's your 60 with the 20 MA on there. And here's your pattern. And here is someone asked about a flag. It's not sloped downward a little bit, but this is a bullish pattern. You have a wide range bar igniting out of a base, and you have this sideways price movement here, creating a new area of support to push higher from. And that is that same area right here. So you can see it's the end of the day. It's still going to be your bias, and you'll take this same plan into the next day. Right? This is a breakout type of a pattern. Okay? It's looking to go higher. Look at the moving averages are coming together, so your time frames are coming into a tighter alignment here, and you have alignment on multiple time frames. It's a great setup. Lucas is saying he pauses to play the 15-minute retracements. Well, it gets into a little bit more of an advanced concept, Lucas. But what's happening here on this pullback is it's creating new support, and you have to, these higher time frames tell you that the odds of it going higher are good. Well, I would agree. If it's extended from the 20, right, you're looking for some consolidation on the smaller time frame. All right, let's keep going here. So here we have a daily time frame that gives us a bias. The 20 and the 50 are rolling over. You might recognize this as kind of a head and shoulders top, but it's tried to go up. Notice the topping tail here and the retest and the drop. It breaks under the prior low and it tries to go up. So one of the concepts that I've used over the years and taught many is what I call bar by bar analysis. And the essence of that is to look at individual bars, see what their meaning is, put it in the context of what preceded it, and then once you're in the trade, you can continue the analysis and see what does that bar mean as it relates to what preceded it. Oh, I went too far. Hold on. All right. Jeez, this is very sensitive. So here's what happened. And what I'm showing you here isn't to suggest that you think that prices will move this fast as what's happening here. But when there is a void and the volatility contracts as it did here, there is that probability as we have multiple time frame alignment. So here we have the 5 minute going sideways here. The 15-minute trend is moving down, and the trend on the 60-minute is flat to moving down. Now, through here, you could have entered here, you could have entered here, you could have entered here, you could have been adding to the position. Right? The point is, what I'm showing you is providing you a bias where the odds are in your favor. Once you pick your entry point based on these patterns, at that point, you're managing. Sometimes your entry point provides you with immediate satisfaction, meaning a breakdown and it drops and you're paid. Sometimes you sit there, which could be for an hour, and just wait for whatever the market to come into alignment, lunch is over, whatever it might be. Point is, if you entered here, you've got no reason to exit. Isn't too risky to enter before breaking the main pivot? No, because the higher time frame is already telling you the odds are that it's going to go down. And if you're thinking this pivot here, it's a good question, Lucas. And I often am asked something like that. And what I was telling you, and what I tell others, and what I come to my own conclusion is that this big picture is more powerful than this little pivot. Makes sense? So we get this big picture bias, and the little pieces there, the assumption is that prices are going to overcome that. It's the same thing as buying a pullback in an uptrend. There's a prior high there that it has to get over, but that trend suggests getting above it. All right, so here's another example. What do I mean by a void? What I mean by that is that there is no reference point of support or resistance, or it's very small. Okay. You'll see on the replay when you get it. But this void here, okay, once it breaks below here, there's little to no support underneath. There's a little bit over here, but look at the size of the resistance. So once it rolls over, it's like falling into a black hole. And that this void concept was, like I said, was a huge epiphany for me, that because prices move between reference points of support and resistance. That is what institutions trade off of. Yes, they might use a 50 or a 200 MA, but the bids are going to be at the prior low or offers at the prior high. If there's no reference point, where are you going to place your trade, the bid or offer? And that is what creates trends and fast price movement. It's a different example, a different type of a pattern, right? But you would have already checked your daily time frame for your bias. You would have checked your trend, support, resistance, void. And here, as prices have moved up, and this turned here, see it went through the moving average. I'm not going to tell you this moving average is any magic to it. It's a reference point. However, prices came down into this area of support. Here was resistance, and as time went by, it moved away from that area, and then prices turned at the prior low. And my moving averages tell me that the 5-minute is moving up, the 15-minute is moving up, and the 60-minute is moving up. And this prior analysis tells me that the odds are in my favor, and that is why I take this trade, even before it gets above this high. What method do you find is the most efficient way of locating these stocks? Do you prefer any particular stock price range or float? Well, you want to make sure that there's adequate volume, that there's activity in it, and there's a lot of different ways, but this is so easy, Island, because all you have to do is scan through a daily chart and find something that's moving up. Right? It could have already moved up 2 days in a row. As long as there's no resistance to the left of it, it could keep going up. So as you move down to your 5-minute time frame, prices could be moving down in that 5-minute time frame, but you're waiting for this to set up. So, I mean, you could just turn on your platform and just start looking through Dow stocks. It doesn't really matter. Just find a daily time frame that's trending in one direction or the other, and it's got room to move. Do I ever enter on a third bull flag? And if so, what are you looking for? I'm looking, if I'm going to enter on a third bull flag, I'm going to make sure that there's that tradable void, Robin, because prices will continue to trend until it reaches some area of resistance or it fails. The moving averages are on the 5-minute, a 20, a 60, and a 200. You can trade futures with it. Pete is asking me if a trade, you can trade anything with this, Pete. It's common sense, meaning multiple time frames in alignment with each other with a higher time frame giving you your bias. It's simple stuff. Of course, the power is putting it together in an understandable way. You could look at moving averages and support and resistance and volume and such until you go blind. But unless you can put it together in a plan, it's not going to make you money. And that's what I'm showing you today. It's simple and it works. How could you know all of my concepts? I'll show you in a minute. All right. So here is one from today. I forget which symbol it was. I think it was ALLY. You could look, I don't know. But the point is you've got what to be looking for here. The alignment of these moving averages with a daily time frame bias. And there was a ton of stuff today that was going down, and you just flip this upside down and you trade it accordingly. How could you tell if you're entering late? It'll be far away from the moving averages, meaning, if, for example, the 20 is down here and this blue line is far away from the purple line and so on, and prices are up here, Tommy, it's obvious that you're late. Wait for prices to pull back toward the blue line, at least, or the 20 MA, or near the prior area of support. Why is the 60-minute trend not the 240? Because I chose to make it simple and just use the 200, Bo. As I explained in a prior slide, yes, the 240 is the 20 MA from the 60 on the 5. I explained was I'm just going to use the 200 because it's close enough. Okay. What is the rule for a stop? It depends on your entry and the stock, but on this breakout here, our initial stop could be here. But based on other criteria, I might decide to put it here under this low with smaller shares and then look to add to the position. Is there a way you can retrieve the recording? Lightspeed will be sending out the recording. Everybody will get the recording. Okay. All right. So multiple time frame alignment, it's going to put the odds in your favor. Right? Multiple time frame alignment. Right? Master Trader Technical Strategies used in this way does that. Right? You're not going to catch the tops and the bottoms using this. Right? That's a whole nother strategy. You're going to get the meat in the middle. Right? It's one of your keys to success here in becoming a master trader. Right? I can show you ways of catching tops and bottoms with climactic patterns. That's a whole nother strategy. For trending strategies and you want to trade intraday, as I said, pick a daily time frame that's moving, that has a setup there. It's moving in one direction. Look at your 5 minute, the way I explained, the odds will be in your favor. You can take a free course. As I explained, you can go, sign up for the chart of the week, but you can sign up for a free course if you're just starting. This is an amazing course that I put together that explains the markets, how they're structured, different sectors, stocks within them, and then giving you a foundation for technical analysis. We trade a lot of options at Master Trader. We have a weekly option service for income. We have a option strategies seminar that you can take. And we have weekly lessons, which, for 11, 12 bucks, I'm going to give you a video audio lesson every single week that's going to teach you something about technical analysis and about trading options, trading stocks, or whatever it is you're going to trade. This is our all-inclusive advisory letter, where on Mondays I give you a whole review of about 20 different sectors, the broader markets. You can see it on the site. You can go and check it out. There's an example of it. And this is a class that I'm in the process of recording right now. That teaches you everything about technical analysis, gap trading, swing trading, scalping, investing, money management, market internals, intermarket analysis, trading psychology. It's a complete course. Those of you that know me from the past, you know that I used to have multiple courses. Well, I've updated all of that for the current markets and in one class that is just fantastic. I don't have a chat room, Ted. We ran chat rooms for many years. It's something I'm considering. I've kind of taken a break from the day-to-day of a chat room, but sign up for the chart of the week. It's free. You'll get on our mailing list, and if I ever do it, you'll have it available. The course will actually be recorded, Ron. Ron is asking me the multiple strategies. How many days is it? It'll be recorded. Look, we used to do seminars over the course of a weekend, and you're brain dead by the end of that weekend. This way, through the recording, you can stop it, you can back it up, you can listen to it again and again and again and again. And after you've taken the course, then I'll spend some time with you in a chat room and take your questions and clarify anything that needs clarification. Somebody's asking me, you can get access to the free course just by going to the site, mastertrader.com, sign up for it, you'll get an email, and you can start taking it today. Won't it be better to apply the same 3 ratio to a higher time frame to get a 45-minute trend? That's a choice, Bo. A lot, look, not a lot, pretty much everything in trading as far as a method is a choice. So as I explained, what I showed you here, it's not the holy grail, but it works. You could apply this to a higher time frame. You're going to get fewer signals, and that's okay. Are you considering offering anything to prop traders? Dave, as far, from my point of view, it doesn't make a difference if you're a prop trader, a Forex trader, or anything else. What I offer you can apply to anything that you choose to trade. I mean, prop trading is nothing more than getting a license and getting additional leverage. It doesn't tell you or suggest that you know what you're doing. You know, and from my opinion, and you can read some of my thoughts on the website under the resources about prop trading, I'd much rather trade futures. I'd rather trade equity minis, currency e-minis, that rather than get licensed and tie up my money for a year, and I'll get just as much, if not more, leverage trading futures. The void strategy has to do with example of fast daily. It could be on any time frame, rapid price movement and movement over time. When do you expect? I'm recording it right now, Keith. You know, once I'm done recording it, which is probably going to take me another week or so, and then process it, it's probably going to be a couple of weeks. Somebody's saying I'm your idol. Thank you so much. I wish my wife would tell me that. Time frames are using, I'm using the daily, and then I'm using the trends on the 5, 15, and 60 to be in alignment with each other. You can, if you want to go down to the 2 minutes, Scott, you can do that when the 5 minute would be picking up momentum, and you need a little bit more of an x-ray into what's going on for an entry point, but you've already gotten your bias. How much is the upcoming course? I haven't decided yet, Oma. Well, you know, it's not going to be crazy expensive, and it's not going to be cheap. Someone's asking me, which markets do I trade? I'll tell you a little bit of history. We're getting on a little time here, but many, many years ago when I first started, I only traded stocks. And after, you know, the bear market into 2003, when everything was decimated and decimalization had been going on for a while, it became almost impossible to make money trading stocks. The way a lot of traders were making money were just bidding an offering and you know, whatever the spread was. You know, I mean, they were splitting the pennies by tenths and such, and they were getting paid for adding liquidity. So I started trading futures. And then as time went on, futures trading, the equity futures became more difficult because of the contraction in volatility, and I went back to stocks. The point is, there's no perfect instrument. Wherever there's trend, there's a trend and there's liquidity and there's volatility, it's tradable. To make this question simpler, is there also a void above stocks that have just hit? Absolutely. If it's hitting new all-time highs, there's nothing above, so there's a void. From India here, TA means a bunch. Remove the indicators, Huma. Get the indicators off your chart. It's just a bunch of noise. Right? Just learn how to read price. That's what I'm showing you here. Okay. Exit. I didn't really talk about exit points, Brad. You know, that position management is a whole nother part of the class that I'm recording right now. But you can manage positions either bar by bar or through pivots. Mastertrader.com, Roberto. Mastertrader.com. All right, guys. You know, I'm going to call it here, and I hope you found it helpful. You can email me, Greg, G-R-E-G, at mastertrader.com. Visit the site, sign up for the free chart of the week, get on our mailing list, and you'll know what's going on. Right? Has it been back tested? I've been asked that many times, Bo. Back testing does not guarantee anything. You're looking at the past. What I can tell you is that trend following in a void and buying at the appropriate time with management works. All right, guys, have a great night and hope to be talking to you soon.